Interest rates are heading south. 2 cuts already this year, and traders are betting on more before Christmas. Today, I will show you 3 smartest moves property investors can make right now to turn this rate cut cycle into real wealth. Let's get started. Hi, I'm Eric Lee from QBS Partners. I'm an accountant and a buyer's agent. Every week, I unpack tactics to build wealth and save tax through property investment. If that sounds useful, smash the subscribe button and stay tuned for future updates. On 18th of February this year, RBA trimmed the cash rate by 25 basis points to 4.1%. And on 20th of May, another 25-point cut brought it to 3.85%. Futures pricing implies roughly about 70% chance of a further rate cut in July meeting. And the market sees the cash rate around 3.1% by year-end. According to CoreLogic, historically, every 0.25% drop in cash rate adds about 1.5 to 2% to the national dwelling value over the following 12 to 24 months. Don't get confused, this is on top of other macro and micro factors. And PropTrack says the same 25% cuts boost the typical borrowing capacity 2 to 3% for median income borrowers. So basically, cheaper debt, rising capacity, and a good chance for capital growth. And it is what's happening now. In this situation, I want to talk about 3 things you can do to benefit from this situation. Firstly, get your lending strategies aligned. There are many strategies, but let me tell you 4 of those to help you to manage your loans more effectively. First, it may be a good time for a rate hunt. In some instances, a mortgage broker can shave 40 to 50 basis points off an existing loan just by switching lenders. On a $700,000 mortgage, that's roughly about $3,500 saved in year 1. Secondly, consider to unlock the equity. Rising valuation plus lower assessment rates let you unlock equity for deposits, renovations, or just a buffer. And the third strategy is debt recycling. In short, debt recycling is about converting non-tax deductible debt into tax deductible debt. Actually, this is one of the topics I already covered in my previous video, so if you're interested, bookmark the video link above. The last one is using interest-only loan plus offset account as a combo. Park your surplus cash in the offset account and pay interest only on the loan. Preserves cash flow flexibility while still having a rainy day pool. The second thing you can do in this situation is to expand while serviceability is up. Lower interest rates don't just cut payments, they actually raise your ceiling. As mentioned earlier, lower interest rate will unlock your borrowing capacity, and this is your chance to expand. However, do not blindly go into the market and borrow maximum amount you can service today. You need to stress test your situation with about 2% buffer to be safe. And also what you can do is that you can buy cash flow friendly properties so you can actually reduce the risk of cash flow issues in the future in case of rate increases. At the moment, regional Queensland freestanding houses still yielding around 5% and Perth infill unit showing about 5 to 6% and vacancy rate is under 1%. If you want to maximize the tax savings, you may consider brand new properties which will give you the incomparable depreciation benefits. But you need to be very careful with this type of investment done. Lastly, squeeze more juice from what you already own. With the additional borrowing capacity, you may consider uplift what you already have, such as fast cosmetic renovation like painting, flooring, and light fittings, etc. This will give rise to your property values, which potentially unlock the equity of your properties even more. And rental increase is a bonus. If you do this, don't forget to order a fresh depreciation schedule once your renovation is done. The minute you improve the value of your property, extra deductions means extra cash flow. And adjust your PAYG variations so the tax benefit arrives in your pay pocket each week, fortnight, or month, not next year when you lodge your tax returns. Actually, this is the topic I posted about 2 weeks ago. So if you are interested in this, you can visit my channel and watch that video too. After the 2012 interest easing cycle, national dwelling values rose roughly about 5% in the first year. After the 2019 cut, they jumped about 7% within 18 months. Past isn't prologue, but history does rhyme. RBA's May statement puts trimmed mean inflation back inside the 2 to 3% band. With unemployment under 4%, the bank says it has a room to lift some restrictions, so more easing is on the table. Markets are pricing 3 rate cuts in total this year. Even if you get only 2, cheaper money is here for a while. That's for sure. So don't sit back and watch others doing, but take actions on what you can do today to grow your wealth. I hope you can deploy some of the strategies I shared today and hit the ground running for your bright future. If you like this video, please hit the subscribe button and I will see you in the next video. Bye for now.